what is a stop loss order and is it important? A stop loss order is an order that you can place on a position that you already own that will be triggered to execute if the stock price drops below your predetermined target. So, in other words, let's say that you buy a stock for $20 and you predetermine that you're only willing to tolerate a 10% drop in price, and that 10% drop is reason enough to sell the company. If that's your position, then you would put a stop loss order in to sell all your shares once the share price reaches $18. You bought it at 20, 10% down is $18. So if the stock trades at 18 after you put that order in, your order would be activated and immediately sell at the next available price, which could be higher or lower than $18. If you want to ensure that your shares sell at $18, you have to put in a stop limit order. But if it triggers at 18 and can't be sold for 18, it won't execute. So it doesn't necessarily guarantee that you will limit your losses. If the stock price only goes lower, it won't fill at all. $18 would have, a stock price of $18 would have triggered an execution, but you said you don't want to sell it for less than 18. So this tactic, in my opinion, is not very important at all unless you're a trader rather than an investor. Therefore, it is not a tactic that is employed in our strategy. If you have a conviction to sell a company that you own, you should just do it. You shouldn't set a price for it. If you're that convicted, you should just go ahead and do it. Putting a limit order in removes your option of evaluating why a stock is moving down in price to see whether the sell is actually justified or not. It just happens. If you don't have conviction enough to keep the company for the long term that you're purchasing, you should probably question whether or not you want to buy it in the first place. Think about buying a house. Are you going to monitor the day-to-day value of your home so closely that it goes on the market as soon as it drops so far in value? I mean, it's not the same thing as a stock, I get it, but maybe it drops in value. Maybe your home drops in value because it needs a few repairs, but when you assess the situation, you determine that it makes more fiscal sense for you to make the repairs than it does to sell the whole thing and try to buy something different. So the wisdom in considering a stop loss is that it forces you to really think about what your reaction will be if your investment drops by 10%, 20%, or more. If you would be moved to action by a 10 or 20% drop in the investment that you're looking at, you probably should really reconsider whether or not you should be purchasing that investment at all. Let's say that you do the stop loss order and your order fills. What now? You've locked in a 10% loss. Congratulations. And you have to make another decision. What are you going to do with the cash that you now have left? What if you're trying to figure that out and you determine that the best place to invest is in what you just sold for 10% less? Because maybe it was just a knee-jerk reaction to some kind of news and it didn't turn out to be as bad as you thought. And the price has now moved higher than where you sold it. So you locked in a 10% loss and now you think that that investment is the best place for your money to go. So you've really just created a permanent loss for yourself. So if you get triggered just hearing about stock volatility and it makes you question whether or not you have the stomach to be your own portfolio manager, then perhaps you should consider our fund or ETF models rather than the investment model where you're actually building your own portfolios.